Hello and welcome to the Hawaii Housing Report, special Honolulu edition. It is November 22nd, 2024. And I can't believe I'm saying this, but interest rates have climbed up to nearly 7%. And while home sales continue their elevated path, condo sales remain sluggish. To help us unwrap it all and to understand what is next, we have Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, how are you today?
Aloha, Patrick.
Hey, great to see you. And let's start with interest rates, Paul. Just a few weeks ago, the Fed's cutting the Fed funds rate. Interest rates seem like they're going down. We're talking about maybe we're going to get into the 5 range. And now suddenly everything has rebounded back up. We're close to 7. And now there's talk of rates going higher. What is going on?
Well, there's just a lot of uncertainty associated with the election outcome. So, knowing who won resolved one uncertainty, who was going to win, but it immediately raised the question of what economic policies would follow because the incoming president has advocated for higher tariffs, which present an inflation risk, and has advocated for renewal of the 2017 tax cuts and other policies that could imply larger federal budget deficits and potentially higher interest rates as a result. It's the uncertainty that's the problem. I'm not saying that's going to happen. I'm just saying that when people don't know, and I don't want to bust on these guys, but I mean the cabinet appointments so far aren't reassuring, and it's the uncertainty that's really the problem. One way to directly, like see the source, the manifestation of that uncertainty is to look at this the gap between mortgage rates and the 10-year Treasury note yields that we've been talking about this now for months because
Yes.
we've been thinking it should come down. And in fact, this year it was, and then all of a sudden comes the election and it just immediately jumped up. So the historical baseline is about 1.75 percentage points or 175 basis points. And if you thought that the long-term 10-year note yield was going to be at 3%, then add 1.75 to that. You got a 4.75% mortgage, which is pretty good. But
Yes.
now with the uncertainty in the treasury yields, if you're talking about a 4% handle, and then you add this 2.4 percentage points, even in equilibrium, that's almost 6.5%. And
And so, Paul,
we're
Paul,
we're
this
north of
this
that
is
right now.
something that you pointed out early on in the pandemic. You noticed this, and nobody else was talking about it. This
It's the
spread,
spread.
this
Yeah.
spread right here, and the risk associated with this risk premium, we've been
This
calling it. This
this
is
is a
due to the
measure of this.
uncertainty. So
Absolutely.
the
Yeah.
election has happened. Now there's this little uncertainty, bumps it
Yeah.
back up, and that's what we're seeing in the rates. Well, that makes
I think
sense.
I think the underlying downward trajectory is still the correct trajectory. And as some of the uncertainty about what comes after January, 20th, the inauguration, as that uncertainty is resolved, in principle, that risk premium should continue to abate, which would mean it could come down another 50 to 75 basis points. The 665 or 675% mortgage rate we're talking about now, just with the abatement of the risk premium, could be 6% without
Yes.
anything else happening.
Right. And then hopefully rates will come down a little. The risk premium comes down a little. We have this big hit. Well, Paul, let's bring in Anders Hostelley from Rate Mortgage to get an idea what's happening on the street. There he is. How's it going,
Hey,
Anders?
hey guys.
Hey, so Anders, you and I kind of talked a little bit during the week, and the rates have been
Hmm.
going up and up and up. We
I
weren't too
know.
happy about it.
Hmm.
Where is it right now, 30-year vanilla loan? Are we up against that 7%?
We're getting there. I mean, rates have moved up, pretty consistently in the last few weeks. And yeah, we were getting, I don't know, it's the high sixes right now for a 30-year fixed rate mortgage.
And I'm gonna
So yeah,
This is the information from
yeah,
Freddie Mac that was
yeah,
released yesterday,
there
showing
you
at
go.
6.84. Is that kind
Hmm.
of what you're seeing as
That's
far as
about
what's being
right.
quoted?
Yeah, that's about right. Yeah, exactly. And you can kind of see, I mean, I know Paul was just talking about this, right? As far as rates and what they've been doing, but yeah, we've seen this little,
Yeah.
move up. We had this nice little rates had moved down in September, and we actually were starting to do some refinance transactions.
Right.
And
If we look at this, this chart is the last 10 years. And then
mhm,
we can see, of course, we're all familiar when the rates started to go up. And then we
mhm.
can see it just sort of wiggling in this zone. You had mentioned earlier something about, is it Fannie Mae that puts out projections for the year ahead?
Yeah, they put out forecasts. So the forecast was like in the high fives for 2025, and they just revised it either yesterday or today to like I think it was 6.2 to 6.4%, which means it
Unbelievable.
would be just a little bit lower than what we where we're at right now. Yeah,
Right.
yeah,
It's just baffling, right? We're
I know.
convinced that the rates are going to be coming down. And then what
Mhm.
about the adjustable rates?
Uh,
Those
I,
improved at all,
we're
or
starting to see some of the local, the banks and portfolio lenders are starting to lower their arm rates, and I think that really is, um, they're kind of looking at, wait, where do we need to price our arms, and we can get a good yield on them, and they're looking probably for a little bit more business too, just because things have slowed down on the
yes.
mortgage side. Yeah.
If we're at 6.8 on a 30 year that we're just looking at with the Freddie Mac, what would the difference be
I'm
on an
starting to
adjustable?
see like almost like about 3/4% in rate, or even 1% in rate if it's a 5-year
Okay.
arm. So yeah,
All right.
it's a nice spread I'm starting to see compared to
Okay.
the trade.
And then I know in the past months, VA was
Hmm.
almost a point lower. How is VA? Where is that tracking?
Yeah, so VA is about a point lower. So in a typical VA borrower, they don't like to pay points. So I was just pricing one. It was about 6.15 with no points.
I
Uh,
see.
yeah, so it's
Yeah.
still quite better than a conventional loan.
Okay. And I know that this is a tough question, but I'll ask what's your advice? You're a buyer in the market, you're an escrow, you're looking to close, you're looking to
Mhm.
lock. What do you tell a buyer right now?
I mean, there's a rate. Here's the payment. This is what, this is a 30-year fixed rate. Let's say if we're talking about that, that doesn't mean you're going to have this rate forever. You're going to get in, you're going to live in your property. You'll see appreciation over time. It's a good investment. I would lock in. I wouldn't try to play the market. We've seen people that were like, oh, I think the rate, I seen over time, I should say, where somebody may be just trying to get a little bit of a lower rate, and then the rates move up, right? It gets away from you. So it's always the safest to just lock in right away. And then,
Okay.
yeah, an opportunity is like, let's say in 2026 or in 2025, rates, do come down. But, we can always look at refinancing.
Yeah. Okay.
Mhm.
That makes sense. And then are you seeing any noticeable change in applications that are coming in or rate locks? That's always a nice indication of what's next.
Yeah, like today was a good rate lock day for us, but the last about 5 days was not good. So rates had come down just a teeny bit today, and I think there was people on the fence, and they said, I better just lock in.
I
Um,
gotcha.
Right.
Yep.
So, but as far as trending, I mean, applications and have started to slow down.
Okay. Well, just for fun, and I don't expect you to be right. What
Mm-hmm.
do you think? Where are rates going to be December 31st of this year?
Of this year,
Yeah. Yeah.
I don't know. I still think some things could happen. Maybe about 40 basis points less than now. Like
Okay.
that graph we just looked at, Freddie Mac is at 6.82, maybe at 6.42,
Yes.
something like
Well,
that.
maybe if we start saying it's going to go up every month, then it will start going
I think
down.
so. Yeah, we've got to use that. It's like,
Sorry, it might
I'm with
be
you.
our
I'm
fault.
with you. Yeah. Yeah.
All right. Well, Anders, thank you very much. Really
Thanks.
appreciate
Thanks.
hearing from
Thanks
you
for
and what's
having me.
going on, and we'll look forward to seeing you soon.
Thanks for having me. Thanks.
All right. Well, stand by. We'll be right back with economist Paul Brewbaker, and we're going to take a look at some housing statistics. Okay, and we're back with economist Paul Brewbaker. Paul, wanted to get your opinion on something before we jump into the housing statistics. This was a headline from today's paper. Honolulu City Council's empty homes tax measure advances. This is a proposed tax on empty homes in Honolulu, which could be as much as 3% per year. Sounds like a terrible idea to me. What say you?
I say that my council member, Esther, is an Akamai person, and Augie, you go, bro. This is a lame idea, and I'm glad those two voted against it. Can I show you some statistics for a second about this? Just so
Absolutely,
we
please.
understand what's going
Yeah.
on.
Yes.
Here are the actual data on empty houses statewide, and then I'm showing West Maui just to give a feel for what you should expect to see in a tourism destination. So vacant houses, they're second homes, right? They're people's second homes. And if you're lucky, you have a second home. If you're lucky, you have a pied a terre, a little apartment in town so you don't have to, commute all the time. Or you have a cottage that Tutu left to your family up in Kula on Maui, when after she passed away. And the moral of this story, if you look at either the statewide numbers where about 85% of houses are occupied and the other 15% are vacant, or if you're looking at a tourism destination where it's more like 60-40, there's lots of vacation homes in a tourism destination, no duh. And if you want more houses, the solution always is to build more houses. So all this stuff about, you know, the homeless people are not going to move in to the 30th floor luxury condo of a tower in Kaka'ako. You are not going to solve the housing shortage by
Yeah.
making people whose Tutu left them a cottage in Kula or a cottage in Ka'ava a higher tax than everybody else.
And the empty homes, even if it is in Kaka'ako and it's the $1 million, multi-million dollar property, what great neighbors. They're paying
Bro,
property taxes. They're not using our roads,
take the
right?
money. We should have more empty houses where people are paying property taxes and not using public services. I mean, it's
Right.
so idiotic. I'm so sorry.
It's,
So,
yeah.
Esther, props to you. Augie, you my man, bruh. That's way
Okay.
to go. Vote against that
Okay.
stuff.
All right, Tommy. Tommy Waters, I'm counting on you, brother.
Tommy, come
Go for it.
on.
All right. Okay. So let's jump into some of the housing statistics and let me pull this up here. So these are the latest stats from the Honolulu Board of Realtors. Of course, this is last month's because that's how it works. So here we're going to look at active inventory, looking at single family homes. We can see it's up 20% from last year. But the big thing here, really compared to pre-pandemic, we are still down 50% in inventory for single family homes. I have a good friend of mine. He and his wife just had a baby. They would love to buy a bigger house. They are
Mm.
locked into a sub 3% interest rate in their home in Manoa. There's no way
What?
they're going to go buy something at 6 or 7%. This really isn't going to change until rates change, right?
No, it's going to be a while if you're just waiting for the rate environment to be the determining factor. Now, time, time goes by and people's life situations change, and there's going to be some movement eventually, just because, people change jobs, people move
Yeah.
to, all of that stuff. But if you're waiting, and trust me, I've been waiting for mortgage rates to come down, it's going to be a long and evidently fruitless wait.
Right, right. And I mean, the only other thing that adds inventory is building more, and we're in
There
such
you
an
go.
anti-development.
There,
Uh,
there's one solution to a shortage of housing, and that's to build more housing.
that's
The
it.
end, full stop.
Exactly. Okay, let's look at condo inventory and just point out a couple things. This is the train wreck. This is what we keep talking about, the
Yeah,
pileup of inventory.
yeah,
50% more condos on the market than last year, and then 64% compared to 2 years ago. Paul, we've talked
yeah.
about it before, but what are the big things driving this right now?
Well, the most immediate thing that has captured people's attention are the rising insurance costs as a result of what we would call geophysical risks, hurricanes and tsunamis, maybe, but really the tropical cyclonic event risk that's probably associated with global climate change has exhibited itself in higher frequency and higher intensity storms with greater damages associated with them. But there's a vintage problem in Honolulu as well. We have a lot of older buildings for which the maintenance expenses are going to be, a persistent challenge for homeowners associations. And you know how it is, the more you defer the maintenance, the more it's going to cost down the road. And here we are, way down the road for some of these buildings in Honolulu. Now,
Yeah.
the thing I've been concerned about is the fact that the jump in inventory to sales ratios, this is the months of inventory remaining is what we call it in the real estate market. And two jumps, one associated with the legislation at the Honolulu City and County known as Bill 19 that was passed, an ordinance to further regulate
And
short-term rentals. Yeah,
Paul, let me just interject. We're looking at
yeah,
months of remaining inventory, which is a
yeah,
great calculation, which takes into account the inventory and the number of
correct.
sales, the absorption, and then we can see the higher the number, meaning inventory is piling up, lower the number, less inventory.
And the point you were trying to draw attention to is the fact that single family inventories are nice and stable. The number of units going in onto the market being listed is roughly equal to the number of units being absorbed by buyers at about 3 months of inventory remaining. But you can see for the condos, which usually move in the same range as single family home months of inventory, the condos since the legislative session earlier this year, that's supposed to be SB 2919, where the legislature began to contemplate a state law that would enable the counties to more aggressively eliminate short-term rentals. That just sent a shockwave through the condo market. And so there are a lot of people now bailing out of that market segment before the vacation rental police come after them.
Yeah. So, Paul, here's another way of looking at what we just talked about, which is the months remaining inventory. And
Exactly
we
what we were looking at. Yeah.
Right. And then this is just put in a different way. And traditionally, we would say equilibrium is somewhere around 4.5 months of remaining inventory. Anything
Okay.
above that, we'd consider a buyer's market. Below that would be a seller's market. When we
Okay.
look at the numbers here, 3.3 for single family homes, clearly a seller's market, 5.4 for condo, clearly a buyer's market.
They crossed the Rubicon.
That's there you go. Okay, Paul, let's take a quick break, come back, look at home prices, and get an idea of where we're going to end up as we end 2024. So stand by. We'll be right back with the economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker. And by the way, if you're enjoying this information, please do give us a thumbs up down below and consider subscribing so you don't miss next month's Hawaii Housing Report. So, Paul, let's take a look at pricing. And again, we're going to start to see this separation that we're experiencing between single family homes and condos. We're
Mm.
looking at the year-to-date pricing, and I just wanted to touch on two areas here. First one, annual appreciation, single family homes up 4.8%, right in the long-term trend line.
Yeah,
Condos
four to five
completely
percent.
flat.
Yeah, yeah.
Yeah, condos completely flat. And if we go back the year prior to that, also flat. And then this is really the big story. Pre-pandemic, single family
Hmm.
homes have appreciated 40%, condos only 20% over this 5-year period. What do you make of
Right.
all this?
Well, so let's take the condos 20% over 4 years, is it? Or five? 20%
Five
over
years.
5 years. Yeah, we're getting to the end of 2024. 20% over 5 years, that's 4% per year, with some compounding. That's about the average, for the longer run or 10 or 20 years of data. It's been uh, you know, less than 1% year to date. And that's a testimony to the inventory pileup we were just talking about, right? So just the absorption is not there and the prices just aren't quite as robust. But what's interesting in the single family segment is that the 40% over the same 5 years, which you would say, wow, that's 8% per year. It's actually also moving at 4%, except there was this kind of step up. So it was 4% before the pandemic. And then came the remote work surge, which was an overshoot. But single family homes have settled again on a 4% path that's upward shifted, like intercept shifted, and is evidently not coming back. And I should apologize. These are September numbers. You gave me the October numbers, but I just checked. They're right in that same zone. So condos kind of on the path they were on pre-pandemic. No shame. They're still getting 4% over time, if not 5. They are drifting off the trend because of the inventory pileup, but single family homes, partly because of this remote work phenomenon, people prefer to work in a larger dwelling, in a detached dwelling, a more suburban or ex-urban dwelling. Condos in Honolulu are located in the urban core. When you take the longer view and also look at the neighbor islands in this same context over time, the neighbor islands where prices have more of a roller coaster, right? They have a larger cycle, but in the long run, match up with prices on Oahu. The neighbor islands are exhibiting this same remote work surge. Remains to be seen if things will stabilize at the higher path or not. But this is just one of those pandemic legacies where, at least for single family homes on Oahu, and then the data I showed for the neighbor islands were all houses aggregated because the condos on the neighbor islands are mostly in resort areas. They don't occupy the dense urban core the way they do in Honolulu. But
Right.
in housing valuations around the state, and especially single family homes on Oahu, you see this step up. The path's the same, but it's like bonus. You got a remote work
Right.
windfall.
Right. So you see the condos, there'll be oscillation, but you think it's going to sort of just continue on this
They're.
elevated path in the
I think they're
four and
on.
a half ish range.
Absolutely. I think a condo is a perfectly good. By the way, relative to a single family home, which did this, a condo is kind of a bargain. I mean, I'm just saying,
Yeah.
it's these prices aren't going to go down materially over time unless somebody builds 150,000 units on Oahu, like that's going to happen. But yes, the condos are under pressure right now because of these insurance and maintenance cost issues we talked about, the vintage problems,
Yes.
and because of the stigma attached, the risk of being in the condo space, say on the Malka side, the Alawai Boulevard, Malka of Kuhio Avenue side of Waikiki, where a lot of condos are in use as vacation rentals. There's a risk factor there that I think investors are wary of, and that new buyers are hesitant to make
Right.
commitments in.
Yes. Yeah. And the vintage problem is a really big problem in our
And
condo
it's not
stock.
going away. The buildings are
That's not
getting
going away.
older.
Yeah. And
Yeah.
I think the good outcome of this is the public has become more aware of this and are asking the right questions now, because some of those buildings with the deferred maintenance, it's going to be a real headache
Listen,
moving forward.
if Honolulu City Council members or if state legislators wanted to do the public a favor, they would be looking at issues like that. What can we do to help these owners in older buildings refresh the building and get it up to code or get it up to fire safety or get it up to whatever standard these 50-year-old buildings, 30, 40, 50-year-old buildings,
Yeah.
what can we do as a people, as a public, as a legislature, as a county council to help with the cost of, you know, bringing up to speed these older structures? And what can we do to build more houses? Come on,
Right.
build.
Well,
Let's build new houses so that maybe we can get rid of some of the old houses.
right. Not going to hold my breath for either one of those things to happen out of
I'm
our
just saying, a
government.
new house is going to be hurricane proof. So why aren't
Yeah.
we building them?
Yeah, exactly. Okay, well, Paul, let's move into the speed round then.
Yeah.
And let's start with okay, we're at double points. Looking out 1 year from now. So we're just a year from now, single family homes. What's your prediction on pricing?
Well, where are we now? Do we even know 1.2
1.1
million
and
yet?
change. Yeah.
1.1 and
1.1 and change.
change.
But
What's one?
continuing on that four and a half
Yeah,
ish, five.
continuing on that path.
Okay.
There's no significant new supply. The demand will remain strong unless the economy falls off a cliff. But I think both single family and condo prices are basically good to go. It's just that those condos got that extra lift from remote work. I'm
Yeah.
sorry, the
The
single
single
family
family
homes
home.
got that
Yep.
extra
Yep.
lift. Yeah.
Okay. 1 year from now, mortgage interest rates.
Are you kidding?
What do you think?
Somewhere between 4.5 and seven and a
And
half percent.
10, right?
Oh my God. Is this the one number I have utterly failed to get right for like 2 years running? I'm not even going to try. I mean,
Okay.
do I think it's going to be more likely to be in the fives than the sevens? Yeah, I still think that. There's the reason it's 6.8 or 6.7 when it ought to be six is that weird risk premium that just needs to go away. And
Yes.
once some of the uncertainties resolved with the political transition are resolved in the next few months, I think we'll see some of that unfold the way it's supposed
Good.
to.
Good to hear. Well, Paul, it's always a pleasure. Thank you very much for taking time to be here today, and look forward to our next one. We're going to do an annual recap for the year.
Okay.
Um, yeah,
I
so
thought
should
maybe
be
we
good.
skipped December. Yeah.
Yeah. So to everyone that's watching, thanks for watching. Please again give us a thumbs up below if you enjoyed this, and consider subscribing so you don't miss next month's report. And until next time, be well, be kind, and from Honolulu, Hawaii, aloha.
Happy holidays.